Can defense investment be sustainable? The European Commission thinks so. A plan from the European Commission to facilitate the ramping up of investment in EU defense, issued June 17, included a notice on the application of the EU sustainable finance rules to the defense sector. This has been a controversial topic because of the perceived high risk of funding companies involved in the production of weapons. The notice provides clarity that was needed in the context of the Commission's calls for mobilizing private capital in support of rearmament efforts. It explores whether and how investment in defense can clear the test to be considered sustainable investment under the European Union's Sustainable Finance Disclosure Regulation, SFDR, Regulation, EU, 2019/2088. The guidance will likely contribute to further ease reputational concerns around defense funding, but will also put pressure on traditional sustainable investing approaches. For an investment to be considered sustainable under the SFDR, two tests are involved. The first requires an assessment of whether an investment contributes to a sustainability objective. On this, the Commission argues that the defense industry is a crucial contributor to the resilience and the security of the Union, and therefore to peace and social sustainability. Given its contribution to resilience, security, and peace, the EU defense industry enhances sustainability in line with the United Nations Sustainable Development Goal, SDG, 16, peace, justice, strong institutions. The UN SDGs are a popular reference for impact and sustainable investing, so the Commission's attempt to carve a place for the defense sector within that framework is a strong statement in favor of legitimizing defense within the EU sustainable finance rules. Analysts at Berenberg, a prominent financial advisory firm, similarly argue that defense investment has become a prerequisite for sustainable investment goals and for minimizing ESG risk to corporates, pointing to SDG 16 as the underlying rationale. The second SFDR step requires demonstration that the investment does not harm any sustainability objectives, something that is arguably difficult for lethal weapons. The Commission notice outlines how investment in EU defense could clear even this high bar. The notice argues that financial market participants investing in the defense industry should focus on three principal adverse impact indicators to establish whether an investment is harmful. These are defense companies' involvement in controversial weapons, the risk of weapons being used for violations of UN Global Compact principles or Organization for Economic Cooperation and Development guidelines on human rights, and companies' processes and mechanisms to monitor compliance with those principles and guidelines. The Commission argues that the risk of adverse impact is mitigated by the fact that the EU defense industry is highly regulated and subject to rules on the production, use, and transfer of the products and technologies it develops, including weapons, within and outside the EU. The notice also clarifies that controversial weapons under the SFDR do not include nuclear weapons. This is important because lack of clarity on whether nuclear weapons should be considered controversial has previously resulted in low tolerance for exposure to their producers across the EU banking and investment fund industries. The notice thus outlines a framework in which funding of EU defense companies could qualify as sustainable investment as long as 1. The companies do not produce anti-personnel mines, cluster munitions, chemical weapons, or biological weapons, and 2. They comply with EU and national export control legislation and have policies and due diligence in place to meet the UN and OECD human rights provisions, while following good governance practices. Prominent institutional investors including UBS Asset Management, Allianz Global Investors and DWS Group have lifted bans on defense investing, and the share of European sustainable funds that invest in the defense sector has increased from 25% in 2021 to 35% today, compared to 51% of conventional funds. A move towards sustainable defense investing will challenge traditional sustainable investing approaches that exclude companies based on the share of revenues they derive from defense. The Commission guidance argues that generalized exclusions are inconsistent with the EU's strategic needs and priorities, and calls for a case-by-case assessment. However, for this to be enacted in a credible way without diminishing sustainability standards, changes will be needed across both the defense and the investment industries. Data on geographical and product segmentation of defense companies' revenues will need to become more granular, and transparency on due diligence policies and processes will need to increase. The Commission guidance refers prominently to EU export legislation, but it is a prerogative of EU countries to grant export licenses. A credible push towards EU defense capabilities should feature a centralization of these provisions. Finally, financial market participants who elect to follow this trend will need to embrace the greater accountability that comes from more flexibility, and crucially translate that into more active engagement with the companies they fund. Silvia Merler, an Italian citizen, is a non-resident fellow at Bruegel and the head of ESG and policy research at Algebris Investments. She joined Bruegel as affiliate fellow in August 2013. Her main research interests include international macro and financial economics, central banking, and EU institutions and policy making. Before joining Bruegel, she worked as economic analyst in DG Economic and Financial Affairs of the European Commission, ECFIN. There she focused on macrofinancial stability as well as financial assistance and stability mechanisms, in particular on the European Stability Mechanism, ESM, providing supportive analysis for the policy negotiations.